So as Grady makes his way up, because everybody remembers Grady, Chris Ayala is to my left with Towanda Capital, Dustin Gross with Mollenhour Gross, and Bill Nix with Greater Sum Ventures Acquisitions. So let's start with you, Chris, and you were one of the co-conspirators in setting this whole thing up. So first, thank you. And second, tell us about Towanda Capital. And I'll briefly say, when you first told me you named it Towanda Capital, I thought it was named after that scene in Fried Green Tomatoes where the lady runs her car into the other car in the parking lot over and over again and yells Towanda because her name's Wanda and she's celebrating herself. But it's not named for that. Oh. So tell us the story behind Towanda Capital.
I live on Towanda Trail. Sure. So Towanda Capital is based here in Knoxville, Tennessee. I'm Chris Ayala. I'm the managing partner of it. Towanda follows a methodology called Search Fund, born out of Stanford's Graduate School of Business. Effectively, it's a group of limited partners that have sponsored me to go and acquire a single business from a seller who's either looking to retire or advance to the next stage of their career. And I come in and I actually roll up my sleeves and operate the business as the CEO. Our focus is really on 100% acquisition of the business, although we do like working with a seller who would be interested in putting capital proceeds from the sale back into the capital structure of the business as well. Our investment focus from a geographic perspective is all over the country, although I do like Knoxville and the greater Knoxville area because I own a house on Towanda Trail. And from a deal perspective, we look at mature businesses. Businesses generally generating north of $7 million up to about $50 million that are cash flow positive, that have EBITDA performance of at least $1.5 million, probably up to about $8 million. Basically have access to do a deal just up to about $100 million in acquisition value.
And it's fair to say you are currently searching.
Oh, yes. Yeah, it launched March 1st of last year, so coming on a year. Over the last 9-10 months, or I guess now coming on 12 months, I've actually been under LOI with 3 different companies in 3 different states. During the diligence process, a couple things happened that we had to reassess the opportunity. And currently actually under LOI with 1 company, but should that one not work out, certainly still in market.
And just because I think it's a fascinating model, and there's only so many searchers out there, as it were. You probably know how many, but then is there a time horizon from your backers to say, look, we need to have a company that you're running within a certain number of years, and then once you get that company, what's their expectation and how long they want to see you run it before someone else buys it or they have some sort of exit?
Yeah, absolutely. So the upfront engagement, I'm capitalized to run operations for effectively a 2-year period of time. So all operating costs, including salary, overhead, travel expenses, everything else is built into that number, which is a budget I set when I went out to my LPs to raise the capital. From an investment standpoint, a little bit unique. I do have some private equity LPs, I have some family offices, and then I have some high net wealth individuals. For the most part, these people are writing checks out of their own bank account. And so there really isn't an exit that you'd see in a traditional private equity format. I don't have a 5-year return requirement. If the investment is a good investment, cash flows positively and continues to grow, we could own it as an asset for 30 years. Or we could own it for 5 years, and if a private equity firm came in and wanted to buy it, that's available as well.
Awesome. Thanks.
Yeah.
Dustin, tell us about Mollenhour Gross.
Yeah, so I'm Dustin Gross with Mollenhour Gross. My partner Jordan and I both live here in Knoxville, so we're based out of here. And our structure is a little bit different than some of the other people you've heard from, as opposed to a fund, which where the GP or the fund goes out and raises money from investors and then takes that and invests it. Our investments come from internally generated funds through the assets we own. I've got 3 small boys, and the way I explain it to them is, we own things that generate cash, and as it accumulates, we use that to go out and hopefully acquire other things that, at least at the time, we believe will do the same. It doesn't always work out that way. And so we're essentially structured like a private holding company. And from a geographic standpoint, we're essentially agnostic. Preferably it would be in the lower 48 of the U.S., just from travel and having to learn a whole new set of rules perspective. But we've looked at and actually acquired things in Texas and New Jersey, and right now we're looking at something in Illinois and Florida. Most of the opportunities that we look at tend to be geographically centered around Knoxville because that's where he and I both are from, and most of the people that we know are here. But as time goes on and we do business with more people in other locations, we have kind of seen that expand and change over time. But from a industry perspective, we're essentially industry agnostic. We care more about, I would say, the model and the nature of the business and the team than we do the industry. And from a size perspective, for purposes of this panel, really what we're most interested in are, similar to Chris, existing operations that have a track record, that have financial statements, that have cash flow and history, and that is somewhere in the $1 million to $5 million of pre-tax earnings is kind of our sweet spot. I mean, we're willing to look at things that are lower than that, especially if it's like a tuck into an existing company that we already own, and we're willing to look above that, especially for companies that aren't fully exiting. Maybe they're selling a piece of what they own, or maybe they're taking on some growth capital to go from where they are to more. But 1 to 5 is kind of our, what I wake up in the morning thinking about.
And just to clarify, you're talking about pre-tax earnings, so a company that may be growing really fast, but that's very top-line oriented, may not necessarily be the right fit for you all, or could be.
Yeah, so to kind of back out a little bit, we essentially, there's 4 or 5 different places that we invest our money or have historically. One of which is just our existing subsidiaries. We're also involved in the real estate business, which is kind of where we started, and we'll probably, once that kind of gets in your blood, it seems to stick. I would expect that we'll be in that for the long haul. We do some things in public securities, but as far as this conversation, we're also interested in what I would call the venture stage, and what I mean by that is where we're a minority passive, we're essentially along for someone else's ride, and we're on transactions for companies in that stage. We are open to lower numbers, but it's kind of a different animal. We view that mostly based on the person and the model, and not so much the history.
Makes sense. Thank you. Bill, tell us the story of Greater Sun Ventures. And this is a fascinating story, which I suspect some of you in the audience know, but my guess is a majority don't. So I think people would be interested to hear the background.
Okay. Well, I'm Bill Nix, Greater Sun Ventures. Greater Sun, or GSV as we call it, grew out of a company that several of us founded called Ministry Brands. And when we've been through, I think, 3 exits with Ministry Brands now, when we exited the second time, a couple of us peeled out, started GSV for the purpose of investing our money in deals. But we were, in my background prior to starting a software company was investment banking, M&A, and so we were being asked by the current sponsor of Ministry Brands to continue doing M&A, and so for them. So we did all the M&A, continue to do the M&A for Ministry Brands. I think we've got 6 platforms now, 1 in property, 1 in behavioral health, 1 in government, 1 in data, and a company called Sign Up Genius, which is all about group management. We're primarily software investors, at least at our platform level. We'll do tuck-ins and add-ons of things like background checks and things like that that are not necessarily software, but are complementary to the platforms that we run. We have operating partners. We have about 4 operating partners that are very engaged with the businesses that we run. We've got our own sourcing team that generates our own deal flow. We've got a real strong. Just closer. Okay. It was probably just as well. We have our own sourcing team, and they create a lot of deal flow for us. We handle the M&A process and invest our funds, as well as several private equity firms that we're aligned with. And and work with them as well. We're not geographically bound at all. We have businesses all over the United States as well as in Europe and Australia at this point.
Talk about some of the numbers of acquisitions you guys have done in Ministry Brands, and the scale and size, because I think it's interesting. And the answers that Bill and Dustin, Chris, and Grady provided to sort of the backgrounders will be up online, the Innov865 website later, so you can kind of get a sense of their profiles there. But I think it'd be interesting for people to understand the number of deals, the volume, and the size of some of them is pretty amazing.
So we founded Ministry Brands around 2013. It was the coming together of several firms, mine being one of them. By March of 15, Providence Equity made an investment, first investment. Between March and November, I guess, we bought 16 companies. We grew our revenue from 12 million to 60 million, I believe, and we recapped again in same year in November of 15 with Genstar for about 8 times what Providence put in. So it was quite the when we're talking about hold periods earlier and whatnot, it's pretty. we're used to pretty short hold periods. We continued on the M&A growth there. About a year later, Insight Venture Partners became the sponsor, paid a little over $1 billion at that point for it, and we've continued to grow it today. It's a company worth over $3.5 billion or something like that today. Property Brands, we started in March of 16. We've just completed the first recap on it. Insight also, we're following the same theme. Providence was our original partner. Insight has come in to now be the sponsor there. We have a Therapy Brands. We're not real creative with our names, so you see Ministry Brands, Property Brands, Therapy Brands, but it works. It's been working really well. So Therapy Brands was started almost a year ago right now, and is growing like a weed. So in all, I guess, across all of our platforms and all, we've done close to about 90 transactions in the last 3 years. We did, I think, 24 last year.
What's the name of your firm?
Greater Sum Venture, or GSV Acquisitions, actually is that technical name. We just call it Greater Sum Ventures, or GSV. Yeah.
Awesome, thanks, Bill.
Yeah.
So Grady, now you can talk about
Why
three roots.
do I have to go after him?
Now you can talk about 3 roots, which I introduced a little bit earlier.
Three Roots Capital is not a fund. Three Roots Capital is a financial institution. It is actually technically a nonprofit financial institution, and we raise capital primarily from banks. There are a number of reasons why banks would be interested in investing in Three Roots. We are certified by the Treasury Department as something called a community development financial institution. We really started Three Roots in the second quarter of 2016. We raised about $51 million between December of 17 really and December of 18. We've committed about $15 million of that. We've actually deployed about $8 million. We're continuing to raise capital because we can raise capital on an ongoing basis. And we are primarily a lender, not an equity investor. So our relevance to this panel is that we can provide senior or junior debt for things like leverage buyouts. We finance everything. We have a manufacturing company in Kentucky we finance. We have a technology company that was in Oak Ridge that we financed. We financed some projects, really more than companies, some projects, some real estate development projects. But as a buyout entity, we can participate in buyouts as a provider of senior and subordinated debt. And I'd say the sweet spot, the biggest transaction we've done to date is $6 million, but we're looking right now at a $27 million transaction and a $31 million transaction. So we have not yet done a transaction that size, but we certainly could and expect to.
And CDFIs are a unique model, so talk a little bit about how many CDFIs are there, or essentially is this the one in Knoxville or in East Tennessee, and also what are some of the criteria that you guys have to meet in order to deploy funds?
So there are, I think, somewhere between 700 and 800 CDFIs in the country. There's more than one in Knoxville. I saw Terrence Carter here, but I don't know if, is Terrence still here? Because Knoxville Area Urban League is a CDFI. They're a certified CDFI as well. They do some different types of deals than we do, but they're also a CDFI. And in fact, we communicate frequently. And there are a handful of other CDFIs in Tennessee. To be certified as a CDFI, you have to demonstrate to the Treasury Department that you have a relevant background and experience and actual deals that you've actually done. And it's modestly like a proctology exam, but not exactly, to get certified. And then to maintain your certification, we have to invest 60% of our dollars and do 60% of our deals in low and moderate income areas. Okay, and it just so happens that we're sitting in a low and moderate income area right now. Everything on Gay Street, everything in Happy Holler. I mean, and we actually invest basically, we do have a geographic limitation based on our certifications. Basically from Putnam County, which is basically Cookville, from Putnam County east, all of Tennessee, and then any county that adjoins that footprint, including Kentucky, Virginia, North Carolina, Alabama, and Georgia. Census tract is, the Census Bureau, everything's broken down by census tract. So one zip code may have multiple census tracts in it. And it's literally, you go to a website, a federal website, you type in an address, and that website tells you if that address is in a low and moderate income area. You know, we financed a hotel in Oak Ridge, okay? It just so happens that downtown Oak Ridge, where they're doing all the redevelopment, is a low-income census tract. So we financed a hotel in Oak Ridge. So, we're very flexible in terms of the types of deals we can do, but we're not as flexible in terms of the geography in which we would do those deals.
Chris, talk about the search. So when I text you, there's an odds-on chance you're getting on or off of a plane. Yeah. So how do you find these companies? Once you do find them, how do you reach out to them? What do you do in that meeting? What are you looking for?
Yeah, absolutely. No secret sauce. It's a lot of hard work. It's a lot of time sitting in front of a computer and doing a lot of reading, doing a lot of research. So sort of like a top of the funnel, looking for industries with tailwind growth in them naturally. You certainly don't want to buy a business that you're spitting into the wind on day one and trying to grow it. So looking for industries, big sort of, they're large, they're growing, even an early stage company where they want to be as well. Sort of taking the step down, looking for the leaders, or at least the companies that market themselves as leaders in that industry. Oftentimes these businesses, the only insight you have into their operations is LinkedIn and their website, and maybe some peer review magazine articles, because they're all private companies. There isn't a lot of information available about them. So then you sort of move down, you sort of put that list together, and that list could be 50 companies, it could be 5,000 companies, depending on the geographic scope and the size of the industry. Stepping down from there, you try and find the CEO, try and find who's the owner of that, use as many resources as possible to get their contact information, and then you put together lists, and you put together emails, and you try and tailor those emails to be different than anybody else that's sitting here or anybody else that's out there today looking to buy a business. And you go out and direct with them. And then as soon as you do, and you get somebody who meets certain qualifications after an initial phone call, you get your ass on a plane and you go meet with the person. You validate who you are, you introduce yourself, you share some vision, you have a meal with them, and you sell them on yourself. That's why I'm always on the plane. And then from there, it's just sort of an ongoing process of validating whether you can get to a fair valuation, whether there's a process in place, and then you try and get them under a letter of intent. Usually has some exclusivity period on it, and then you really work hard during that period to do whatever business and financial, maybe technology diligence you need to do to try and get the business to closing. You bring in a third-party lender. We like to use debt. It helps on our earnout, or rather our return profile. So you got to bring in a bank, bring them up to speed on the deal, and I have to work with my limited partners and advise them of sort of what the deal, what the valuation are, and what's my thesis on why this is a great opportunity.
And of the companies that you've reached out to so far, what percentage are like, hey, this is great, like I'm always looking for options, exit opportunities? I'd love to hear about this search that you're running and what might be possible. And how many are just like, no, I'm not, like, I haven't even crossed my mind to sell. We're just running a company here and we're good. Or they just don't write back at all, I guess.
You get a lot of silence. You certainly get the snippy guy who writes back, or woman who writes back and tells you go to hell. But then you also get the person who says, oh, I'd be interested in a conversation. Maybe a 65-year-old business owner who's thinking about, what's that next step? I've been thinking about this. It's a very opportune time. I think I gave somebody a note tonight. Conservatively, I've probably sent out at least 6,000 emails over the last 12 months. That's probably a really conservative number. I've probably had 600 conversations over that same time. Last week alone, I think I had 40 conversations just because I had a really good mailing list. So it's a lot of quick conversations, a lot of 15 to 30-minute calls. You get a lot of silence. You get a lot of, get lost. But then there's certainly genuine people who are interested in doing deals.
Dustin, how do you and Jordan source deals, or do they come to you? Like, do they hear about you and say, hey, we're ready, we're ready to retire? Or are you also buying companies where the founder or owner wants to stay in, or do you want them to stay in? Do you prefer that?
Yeah, so it's I would say it's a combination. I would also say we're fairly new at this. We've been at it for 4.5 years, and so if you'd asked me 2 years ago, I think it would have been a different answer. And hopefully, if you ask me 2 years from now, it'll be a different answer. But the process at this point, I would say, is multifold. One, we do come across opportunities through our subsidiaries. So, if we already, if we own a business in a space, we're constantly trying to learn about that space, trying to map out, the vendors, the suppliers, basically just that entire industry vertical. And as we get to know those people and know of those people, some of them, sometimes the conversation comes up naturally. Sometimes we actually outreach to people in that industry. So that's kind of one bucket. Another bucket would be, in our mind, we're trying to, what I wake up in the morning thinking about is owning another business, adding another business to our family, so to speak, that it's an exceptional company. It has a demonstrable history of above average performance, and it's ran by somebody who's honest and competent and passionate about it, and who's well incentivized to make it valuable. And so that's kind of what we're looking for. And so we try to get in the mindset of, if I'm that person and I decide I want to sell my business, how is that going to play out? Am I going to talk to my M&A attorney, my CPA, my wealth manager, an investment banker? And so we spend a lot of time meeting with those types of advisors with the mindset that telling them our story, telling them who we are and how we think and what we're looking for and how we operate and how we're structured, in the hopes that as they're out, talking to their clients, and one of their clients comes to them who's maybe, like Chris said, in retirement age, and starting to think about estate planning, starting to think about their kids, starting to think about, what am I going to do with this creation that I've birthed over the last, 10, 15, 20, 30 years, that when that advisor can basically close that gap, that circuit, and say, oh, you should talk to Jordan or you should talk to Dustin. So most of it comes through that. And then every once in a while, you'll get one just from, a friend or a family member who just happens to be in that similar situation that knows about it and says, hey, you should talk to these guys. So it's really kind of a variety of sources on how we find them at this point.
And does your thesis include the owner continuing to run it because they're exceptional and done a great job, or would you buy a company and say, that's okay, you can retire out and we're going to find a new leader to take it over?
Yeah, so there's what we want, and then there's reality and what we kind of come across in the world. And so, even exceptional businesses require people to run them, and preferably exceptional people. And so our kind of home run swing would be where maybe the owner's leaving, but there are other competent, experienced, knowledgeable people with context and history and are passionate about it, kind of the company's blood runs through their veins, so to speak, that are going to be persistent there and are going to stay and can be properly incentivized and have the skills to kind of carry that forward. We have, we have looked at some situations, like we're looking at an opportunity right now where it's essentially a spin out where, it's kind of this, it's a piece of a larger organization that's, I don't want to say the redhead stepchild, but it's not getting, the resources and the love and the attention that that team thinks they should be getting at least. And so it kind of comes with a team, but there's no leader. And so in that case, we don't have like a big bench of star players or NBA types who are ready to jump in and lead. So for us, for that transaction to come together for us, we've got to find someone to kind of put in that seat that we're comfortable with, that the existing team's comfortable with. But it certainly has to have a team, and preferably it would come with the organization. Unlike Chris, we don't necessarily want to supplant the CEO. I mean, preferably the CEO, he or she, would already be there, already be in place, and want to stay. But often that's not the case. Often it's kind of an owner-operator, and so that who's going to run this business after the founder leaves is a pretty big question. And honestly, it gets pretty messy with families and family psychology and constraint. It can become fairly almost like a psychologist. You have to understand a lot about. We've learned a lot about human psyche, but it definitely has to have exceptional people at the helm because we can't provide it.
So Bill, talk about how you guys go about, essentially, like you mentioned earlier, replicating the playbook. I mean, you've had such incredible success with ministry brands. Now you got property brands, therapy brands, other brands. They're all plural. So the idea is, are you going out and finding a market industry leader and then rolling up more acquisitions under them? Or are you trying to get several at the first go and then add on more? What's kind of the core playbook?
Exactly. So we have, we're very vertically focused, or we're very focused on building the platforms that we create. And we try to find that one platform company to start with. We've got 3 guys in our office that do nothing but research on markets and gin up list after list after list. We've got 5 guys that follow up on that with the thousands of emails that Chris is talking about that often don't get returned. So we have a pretty strong team of people that are searching, but I think one great advantage and one way that we leverage this is once we have this platform in place, and just like we just bought a company in the government space. So I sat with that CEO on Friday, and we went over 30 different companies that he knows that he wants as part of that platform, that he can open the door for, so we can leverage, and we probably across our platforms now have well over 100 companies. So we have lots of tentacles in the marketplace that we can leverage that's very helpful. And we found that once the platform gets rolling, there's a certain momentum to it, so that probably our hit rate's a little higher as we get going, and people know that we're going, and they realize that they probably ought to get on the train as opposed to not get on the train.
Get run over by the train.
I'm not going to say that, but we wouldn't do that. But that helps. So momentum helps.
And like you mentioned before, the ability to leverage big private equity, the Providences,
Yeah.
Insight, venture partners of the world, you really have infinite's too big, but you can do big acquisitions. You can go up to pretty big size. Can you give a sense of kind of the range that you all look for, sort of what's in the strike zone's pretty big?
We can leverage their sourcing teams too, and that's helpful. But yeah, I mean, the largest acquisition I guess we've done to date was about $350 million. And we just have a lot of capital at our disposal to do. So we still, and the way we built Ministry Brands is we bought smaller companies for great prices, rolled them up, got the arbitrage on the multiple, and hit our exits that way. And so that's still kind of the playbook that we're running, though the market's gotten really hot, really heated up. So the multiples we're used to are different than they are today. But
Awesome. And Grady, so CDFI, obviously we're sitting, like you said, in the strike zone for investments. Are these always companies that are quote unquote land-based? Are a lot of these investments in real estate plays, or they can be any type of company, any industry?
They can be any kind of company, any industry. We're not going to do massage parlors and liquor stores and right? So, but we can do operating companies, we can do real estate projects. Really what matters to us is that they're in a low and moderate income area and that there's some community development aspect. Jobs are created, real estate is built or refurbished. There has to be some community development aspect of the business. We're not going to invest in a country club or something like that, but we might invest in, we have a company in Kentucky that's it's in a county, Whitley County, Kentucky, one of the 10 poorest counties in the country per capita. The employees of this company drive from 2 hours away in Tennessee and Kentucky to go work at this manufacturing operation. But it's a $50 million a year manufacturing operation that happens to be in the middle of nowhere. It's a high growth business with a tremendous opportunity for a return for an investor. It happens to be in a place where there aren't a lot of banks and where there aren't a lot of infrastructure and support services for that type of the business. The entrepreneur just happened to start the company there. It's a UT educated former NASA employee who went home and started a company. And so there's been a lot of, he's aggregated a lot of assets and grown a very successful business. So that's an example of the type of company. It's a company that, were it not where it is, it could be financed by a more traditional private equity type investor. It just happens to be at a place that's not easy to get to, or it has some sort of non-traditional elements and aspects to it.
Awesome. Well, I know we got the sign. I want to thank everybody for spending the afternoon with us. We're just scratching the surface of the investment community here in Knoxville. It's safe to say, when we all go home today and say, what the heck did you do from 4 to 6, billions of dollars are being put to work and created in new wealth here in Knoxville, which is pretty amazing. So you'll see on some of the stat charts that Tennessee is about 50% above average in terms of venture capital. But if you look at the real dollar numbers, I think it's safe to say that a lot of that is estimated based on the channels of data that they're sourcing it from. The fact of the matter is there's a lot more happening than I think most of us know and realize. So hopefully the panels today have helped shine a light on the fact that there's a lot of deal flow happening here. There's a lot of great companies starting in Knoxville. A couple years ago, we were also named the #1 state for foreign direct investment. So there's a lot of exciting companies coming into Tennessee from overseas, like Denso, where I used to live in Maryville. So thank you all very much. Keep continuing the conversation. The stories that all of the panelists have from before and here on the acquisitions panel are pretty amazing. So buy them a beer. And let's keep this rolling. Hopefully this will be the first in many in a future investor series. Thank you all for doing it. Appreciate it.